Can you mimic a long call option payoff using only the underlying stock and borrowing money? It might surprise you that the answer is yes. And in fact, that's the key to pricing the option. Welcome back to Derivatives and Risk Education. In this video, we'll explore the one-period binomial asset pricing model. I'll show you in detail how you can use this simple yet powerful framework to replicate an option with the underlying stock and borrowing, and how this leads to a clean, intuitive formula for option pricing. Let's see how this works. We're modeling a single stock. At time 0, its price is S naught, written as S subscript 0. At time 1, the price will be one of two possible values, S1H or S1T. H and T stand for heads and tails, as if a coin were tossed to determine the outcome. It's important to note that we do not assume the coin is fair, so the probability of heads does not have to be 0.5. Now, we define two factors, U for the up move and D for the down move. So S1H is the up factor U times S0, and S1T is the down factor D times S0. We also assume a one-period risk-free interest rate R, meaning 1 at time 0 becomes 1 plus R at time 1, both in the up and down scenario as it is risk-free. Now, an important assumption in derivatives pricing in general, and also in this model, is that there is no arbitrage. We define arbitrage as a trading strategy that starts with no money, has zero chance of losing money, and a positive chance of making money. To rule out arbitrage in this model, we assume 0 is less than D is less than 1 plus R is less than U. D is greater than 0 means the stock price can't fall below 0. D is less than 1 plus R means if the stock goes down, you earn less than the risk-free rate, and 1 plus R is less than U means if the stock goes up, you earn more than the risk-free rate. Now, let's see how we can value an option in this binomial framework. Specifically, we'll look at a European call option, which gives the owner the right to buy the stock at a fixed price K at time 1. Its payoff is defined using the notation max of S1 minus K and 0. The max notation means you get the greater of the two expressions in the brackets. If the stock price at time 1 is above the strike price K, the payoff is S1 minus K. And if the stock price is below or equal to K, the payoff is 0. Now, the fundamental question of option pricing is how much the option is worth at time 0 before we know whether the coin toss results in heads or tails. The arbitrage pricing theory approach to the option pricing problem, which we're using here, is to replicate the option by trading in the stock and money markets. We now illustrate this with an example, and then we return to the general one-period binomial model. Let's plug in some numbers. S0, the stock price at time 0, is 100, the up factor U is 1.2, the down factor D 0.8. The risk-free rate is 10%, which as a decimal is 0.1, and the strike price K is 100. This gives a stock price of 1.2 times 100, so 120 in the head scenario, and a price of 80 in the tail scenario. Option payoff for heads is the max of 120 minus 100 and 0, so 20, and in the tail scenario the option payoff is 0. The option is worthless here. Now, we're going to try to replicate the option payoff using a portfolio consisting of only delta shares of the stock, where delta is the number of shares we hold, and an amount B borrowed at the risk-free rate. So the portfolio value at time 0 is delta times S0 minus B, as we own delta shares and have a debt of B. Portfolio value at time 1 is delta times S1 minus B times 1 plus R, as we still own delta shares, but the price is now S1, and we have to repay the amount B that we borrowed plus interest. Now, we want to find the values for delta and b such that in both the up case and the down case, the value of the portfolio is the same as the value of the option. So we have two equations with two unknowns which we can solve. In the up scenario, the portfolio value for that case, delta times 120 minus b times 1.1 needs to be equal to the option payoff here, which is 20. And the same for the down scenario, where delta times 80 minus b times 1.1 is equal to 0. If we subtract the second equation from the first one, we get delta times 40 equals 20, so delta equals 0.5. If we substitute that into the first equation, we get 0.5 times 120 minus b times 1.1 equals 20, so b is 40 divided by 1.1, which is 36.36. Then finally, option price at time 0 is equal to the value of the replicating portfolio at time 0. So delta times S0 minus B, which equals 50 minus 36.36. So this call option here is worth 13.64. We work this out using replication. We can use this approach more generally to replicate any payoff. Again, we set up a replicating portfolio of delta shares of the stock and B borrowed at the risk-free rate. As before, the value of this portfolio at time 0 and at time 1 are as shown here. The payoff of the replicating portfolio again needs to be equal to the payoff of the asset, so we solve these equations. So delta times S1H minus B times 1 plus R equals V1H for the head scenario, and the similar equation for the tail scenario, where here V1H and V1T are the asset payoff at time 1 in the head and tail scenarios respectively. From these equations, we can again isolate delta. So delta is equal to V1H minus V1T divided by S1H minus S1T. Then the denominator we can write as S0 times U minus T. We can then substitute this expression for delta into our first equation above, which gives this equation. From this, we can cancel the S0 terms and move the B term to the right-hand side. And then we can separate the V1H and V1T terms as follows. Now we simplify and solve for B. Then we can substitute our expressions for delta and B into our expression for the value of the replicating portfolio and therefore the option at time 0. Now we combine this into a single fraction. Then we finally rewrite it like this. So we have shown that the option value at time 0 is V0 equal to P times V1H plus Q times V1T, all divided by 1 plus R, where P and Q are the so-called risk-neutral probabilities of an up and down move respectively. And P is equal to 1 plus R minus D divided by U minus D, and Q is equal to 1 minus P. I want to mention again that in the general case we did not mention the specific case of a call option. This general formula is true for a one-period model for any asset with any payoff in the up and down case. The formula can be read as the value of the asset at time 0 is equal to the probability of heads times the value of payoff in the heads case plus the probability of tails times the payoff for tails. Then we divide this by 1 plus R to account for the time value of money. We said that P and Q are the risk-neutral probabilities of an up and down move. We call P and Q probabilities because in our model they are between 0 and 1, and it helps with intuition. But they are really simply the weights we need so that there is no arbitrage. They're the weights that make the weighted average return equal to the risk-free rate. P and Q do not depend on what the market expects, because the real-world probabilities do not matter in risk-neutral pricing. Why do we replicate the assets payoff? Because in a market without arbitrage, If two portfolios have the same value in every possible future state, they must have the same value today. So if our replicating portfolio matches the assets payoff in both the up and down case at time 1, it must be worth the same as the asset at time 0. If the market price of the asset is too high, you can sell it and replicate, and if it's too low, you can buy it and reverse the strategy. Either way, you profit. Of course, real-world stock movements are far more complex, but we study the binomial model for 3 key reasons. It clearly shows how arbitrage pricing connects to risk-neutral valuation, and with enough periods, it approximates continuous time models efficiently. And finally, it lays the groundwork for advanced concepts like conditional expectations and martingales. We will build on the knowledge from today in future videos. In our next one, we'll extend this framework to the multi-period binomial model. Like, share and subscribe to Derivatives and Risk Education for more insights into derivatives pricing and financial markets. Thanks for watching, and I'll see you then.